Hello everyone, hi, welcome to the channel of Wall Street Mojo.
Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon.
Friends, today we have a concept which is common stock versus the preferred stock. We're going to understand the top 8 differences, and you should absolutely know that. To begin with, we'll start with when a business, when they need more money to invest into, the growing business, they can opt for issuing shares, and issuing shares can be of two types. The first one, it's the common shares, and then the other one that we have is the preferred shares. Now, when we talk about the stocks, it actually means, the common stock. So through common stock, shareholders can earn dividend and can also sell out their stocks when selling price goes up and beyond their purchase price. So the common shareholders are also given the voting rights in the corporate challenges or decision making processes. As the name suggests, the preferred shareholders are given the preferred, you can say preferred over the common stockholder, they are given the preferred rights. So though the preference shareholders are not given any voting rights, they are opted first for the payment of a dividend before the common stockholder it happens. So in this tutorial, we'll look at the difference between the common stock and the preferred stock and would see the similarities and any dissimilarities that come through. So let's begin. We'll start with the inherent meaning. Ordinary shares with the voting rights. The shareholders, the equity shareholders have the voting right and the right to receive the dividends. Voting right is very important. Preferred shares without voting right, but a condition to receive preferential dividend. The preference shares is without the voting right. The condition is to receive the preferential dividend. Now, voting rights. Common stockholders have the voting rights on various issues of the business, and they have no voting rights. The dividend distribution. The common stockholder don't always receive dividend. Board of directors have the right to either distribute the dividend to equity shareholders. They may not, depending upon the availability of the profit. But in the preferred stockholder, as the name suggests, always receives the dividend at a fixed rate. There's always they are going to receive the dividend at a fixed rate that has been decided at the inception. The priority part. The common stockholders are not given priorities since they are considered as the owners of the company. So they are not given the level of the priority that should be given. They take and in case of the preferred stockholders, they are paid after the debt holders, but before the common stockholders. So common stockholders are the last ones to receive at the time of the liquidation. The debt holders are the first one, then they go with the preferred stock, and then they go with the common stock. You can say that the common stockholders are bearing the maximum risk. The transferring right. The common stockholders are not given priorities since they are considered as the owners of the company, so they are not given any priority. But in case of the preferred stockholders, they are paid after the debt holders. They have been paid after the debt holders but before the common stockholders. Now let's understand the sharing of the profit and loss. If there is no profit, common stockholders receive nothing. As I told you before itself, if there is a profit, the board of director may still think whether to pay as a dividend or to invest in the company for any expansion. So over here, it's discretionary on the part of the board of director. But when we talk about preferred stockholders, irrespective of making profits or incurring losses, preferred stockholders have to. They have a right to receive the dividend on a regular interval. It's like, when you take a bank loan, you have to pay interest every month. So in the similar fashion, when you have the preferred stockholders in your company, you have to pay them dividend on a regular basis. Now, what's about the arrear part over here? They don't receive any arrears. There is no concept of arrear in the equity share, but they receive arrears in the next year. Possibility of the growth, it's really very high. The growth is very high, and over here it's low. You can say it's stable. You can say low, it's stable. So over here, the possibility of growth is high, and low or stable, you can say that. Well, these are all the differences between the stockholders or the shareholders and the equity shareholder, the preference shareholders. Now see the common shares or the common shareholders, the common stock, they are ordinary stock that is issued to the public to generate a stream of funding to expand the business. A private company, needs to become public to be able to issue common stock. Now I'll try and make you understand the process of IPO. That's initial public offer. So we'll take an example of illustrating IPO process. See, the IPO process, is a way out to sell the first share of the company in the market or in the public. So let's say Steve has a business in the downtown and he sells his old classic books. So his clients is huge, and let's say he serves a lot of people in that area. So Steve has over here been advised by his friends that how about you should go for big. So he should open stores of his old classic books so that he can reach out to a greater audience. So the idea seems really great for Steve, but he does not have enough cash with him to open stores in different cities. So he goes to investment bank and he asks for help. So the investment bank suggests Steve that he should go for IPO. Steve says that it's a great idea. So he asks the bank for help. The investment bank, they come to the Steve's bookstore and does a valuation process of they come to the Steve's bookstore and they does the valuation process of his business. They find that the value of the bookstore is, let's say, if it is more than $5 lakh, so they advise Steve to go for a 50,000 shares of 10 each share. So Steve decides that he would keep 50% of his shares and would sell out of his remaining 50%, and he sells out closely to 25,000 shares at 10 each. That accumulates to $250,000. So he has now decided to use this money to open new stores in 3 new cities. This is how the whole IPO process works, and it's best for those companies which don't want to go for long-term loans. So if you want to stay away from those kind of leverages, people usually opt for this kind of process called IPO. Now, what is exactly the right of the common stockholders? So you can say that the common stockholders, they are equated with the owners' funds. So if you're one of the common shareholders of the company, you are the owner of the company, and the whole theory of the business revolves in around the common stockholders. The whole business works to maximize the wealth of the shareholder. So, you can say that, the common stockholders have an important role to play in helping the company being a going concern. And at the same time, there are some rights of the common stockholders. They have a voting right. They also have a thing called a right to receive dividends. At the same time, they have a right to sell off their stock for profits. This can be one of the things. And they have a right to receive the remaining cash after liquidation. So these are all the rights of the common stockholders. Now, let's understand something about preferred stock. See, preferred stock are the extension. They are the extension of the common stock, but preferred stockholders are given a preference right in the dividend payouts. Like, for example, let's say if a company issues preferred shares and the dividend payout, the DP remains fixed. So the rate is usually higher. The rate is usually higher than the dividend payout ratio of the common stockholder. The rate is higher than the rate of equity shares. Now, however, if a company does well, the dividend payout of the common stockholders will increase and the dividend payout of the preference shareholders won't, since it is fixed. So in simple terms, the preferred stock is, you can say it is a hybrid version. What is it? It's a hybrid version of the common stock and the bond, because when someone can say that when someone owns a preference shares, he's entitled to receive what thing called dividend, just like the common stockholders. But the only difference is that the preference shares, that the PS, will be given preference in offering the dividends. Like if someone owns preference shares, that is a PS, he or she is entitled to receive a fixed rate of dividend payout. That means if a company incurs loss, it has to pay dividend to the preference shareholders. And if the company makes let's say profit, if the company makes a profit, then it has to pay dividend to the preference shareholders. This is one of the most important characteristics of any bond. So we have done a majority of the portion. Let me conclude now. If your idea is to make more money and you want to see the good and bad of the both the common and the preferred stock, a better approach is to mix the mingle of the two. You can buy the common stock. You can buy the common stock of the growing company and then buy the preferred stock of the mature company. So doing this will help you to get the benefits of both and mitigate one of the another. So if you don't make enough money on the common stock, your dividends on the preferred stock are already insured. And if you also make money on the common stock, you'll be quickly become really very wealthy. So that's it for now for common stock versus preferred stock. Thank
So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.